Hello, everybody. John Momartz along with Bob Key today. Today is Thursday, October 12th. We wanted to take a few minutes and update all of you on our feelings on the state of the market, given the interest rate situation and, more importantly, the conflicts going on overseas. So with that, Bob, I'll let you start.
Thank you. Yeah, it's safe to say that markets have certainly been volatile, and really, if we, the chart we have here, if you kind of take a look, to the start of 2022 to the point we're at now, we would be extremely happy with this performance. Nevertheless, the volatility of the markets, is very unnerving. Our process, what we've always believed, is if we follow the economics, if we follow what has proven to be the historical relationship between economic data and financial markets, despite the short-term volatility, that will eventually play out. And that's what we're seeing right here. So we call these the psycho markets. I think one of the problems exacerbating the volatility right now is quite simply the Federal Reserve and their many mouthpieces talking all the time that would send markets up and down. But we can see on this chart in front of us that the red line is this 200-day moving average. And we hesitate to use technical analysis, and we don't actually use it in our process. Nevertheless, we do listen to what the technicians are saying, because there's a lot of people that make a living with short-term trading. Everybody's been looking at this 200-day moving average, trading back down to it and then bouncing off. That's exactly what's happened. We're actually up about 3% right now off of where it touched that 200-day moving average. And the answer is due to the economics. Once again, 2023 has arrived. Our much promised recession from 2022 didn't happen, from 2023 doesn't happen, and now we're into 2024. We're coming in at probably 2.1% GDP growth rate this year. Inflation is falling, and we will have, if not in the Q3, by Q4, we'll have once again have record corporate earnings. So, we continue to be constructive on stocks. We're going to get the short-term volatility, but we expect markets to continue moving higher over the rest of this year, and then hopefully make new all-time highs in 2024. So let's talk a little bit just about the world in general. Obviously, we all watch the news. Doesn't seem like that long ago Russia invaded Ukraine, and it wasn't that long ago. And oddly enough, we almost don't even discuss it anymore. We all, as crazy as things seem when they happen, markets have a way of eventually looking past the human tragedy and just looking at the economic impact and using that to decide what markets should do. Of course, this past week we had the Israel was bombed by Hamas, and that sent markets lower, sent oil prices higher, etc. But when we look beyond that human tragedy, we realize that geopolitical events tend to be very good buying opportunities. It's always difficult to talk about things and remove that human component of it. But from an economic standpoint, the only real economic impact is potentially higher oil prices. That is, the difference between now and 30 years ago is that we relied on the Middle East for our oil. And not that we still don't rely on them and it impacts oil prices, but we now can domestically produce all the energy we need if need be. So although prices may be higher, it's not an issue of not being able to get the energy. It's just a matter of what the price of the energy will be. And we're able to offset the economic impact of these Middle East conflicts much more than we previously have. That's why you see a lot of people tend to flock towards the U.S. during these periods. It's called a safe haven because we are relatively isolated from the rest of the world in all these political events. I don't know, John, if you have something you want to add to that before I move on to the Federal Reserve policy and the changes going on there.
Oh, okay. I was just going to add into those, but yes, I mean the U.S. is considered the most stable market in the world, the most diverse market in the world. So when conflict is going on everywhere else, global money tends to flock to the U.S. and our stock markets do tend to rise in these situations.
Yeah, and we've seen that this time. We noticed a lot of the money flows into bonds. That's why bond yields over the last few days have really been lower as demand has increased. And the other thing we often see is we see a strengthening of the US dollar, which we've also seen in this case as money shifts out of foreign currencies into US currency. We're definitely approaching a point where there's a shift in the Federal Reserve policy. They've shifted from a tightening mode to what they call a pause. They're referring to it as a pause. I would say it's the end of tightening. I think it's very unlikely that we will see more Fed tightening. And then 2024 will probably be the start of some sort of a Fed easing policy. One of the interesting, or one of the things we reflect upon is we feel like we know we have done a pretty good job of getting the economic scenario right. We've been outliers in saying that there's not going to be a recession, that inflation is going to moderate, and corporate earnings will be fine. What we were surprised about is how quickly markets reacted. Typically, our models show us, our frameworks show us that financial markets tend to react on about a 12-month lag to Fed policy, because that's when you see the economic impact come through. I think what we're seeing now, the markets actually reacted simultaneously, almost a little in front of what the Fed actions were this year. And I think a big piece of that is that they're so much more vocal than they used to be. The Fed, quite simply, didn't even hold press conferences or anything before. They release their minutes. People, the minutes came out a couple months after the meeting. People would sift through the minutes. And now they're so vocal and talking all the time that it seems like investors' reaction to Fed policy is much more simultaneous, and there's not that lag. So markets sold off quicker than we anticipated, given the tightening scenario. Usually they start to sell off about a year after tightening starts. By the same stretch, they usually don't start to rebound until about a year after the tightening finishes. And we're seeing markets starting to rebound now, even though it hasn't been a year. So I guess, Fed Reserve policy, I'm very, very confident in saying that we are not going to get, if we get further tightening, it might be one more 25 basis point hike, but I don't even expect that. The Fed is done with the tightening policy. Inflation is falling. We're seeing the strain on consumers, especially in anything that has a finance-related industry. The risk of tightening more is far greater than the inflationary risk we're facing right now. Talk about future growth. What's interesting during all this is that Q3 earnings are now coming out, and that's a big reason for this recent rally. Q3 earnings are coming out. It looks like we're going to get about 10 to 12% growth rate in earnings right now, and that's those are wonderful numbers. So we did not have a recession. Inflation is moderating. Corporate earnings are growing. There's a lot of diversity in this economy. So even though it's kind of like a rolling recession, we would call it, like different industries are kind of hurting at different points in time, but overall the economy continues to be just fine, and we expect markets to mirror that and really just continue their slow correction in stocks, and then bonds are probably going to hang out around these levels, which again, people think these levels are high because we've gotten used to the zero interest rate policy. A 4.5% rate on a 10-year bond is a beautiful rate. It's a healthy rate. It's a rate where it's a rate that people should be financing at. It's a much more healthier market than the 0% interest rates we've gotten used to over the last 15 years.
Thanks, Bob. I think all I would add is just a quick summary that despite these current horrible conflicts going on in the world, we are staying focused on our data and looking at the long term, and the economics really suggest better markets for the U.S. going forward. Unlikely of any future federal interest rate increases. If any, it will be small. More likely for them to cut back before go forward. Earnings look good. We continue to be positive on the markets. I know today we had an inflation number that was a little bit higher than expected. That's really a short-term view. Long-term inflation is going down at a pretty rapid pace. So again, we stay constructive on the stock market, and we'll continue to do so. And we look forward to talking to all of you in the coming weeks. If you have any questions, as always, feel free to call me. We can get you in touch with Bob as well. And have a great fall, and we'll be in touch.
Take care, everyone.
Thank you all.